In this video, traders, let's have a look and see if the next stock market crash is coming. Stay tuned. Hey guys, warm welcome to you. Alright, so is the next crash coming? Let's look at some potential catalysts for it. Let's look at some technicals as well. So first of all, I want to distinguish between a few things. We've got a lot of disparity and a lot of variance between European indices and the US indices. FTSE 100 in front of you here, guys. We are way below the midpoint of the pullback. Pre-coronavirus highs, low pullback. We're sitting down here. This isn't a very bullish chart. In fact, we've been range bound for a long period of time since mid-June, and we're just trickling low. We kind of have little moves high, little moves low, very range bound. But then, going back to my point I was going to talk about in a second, you've got to look at the constituents of the market we're trading. If we're talking about, are we going to have a broad market crash? People are probably talking about the S&P 500, Nasdaq, Dow, FTSE 100, DAX 30, all these kind of things. But in actual fact, the constituents are so important. If we looked at the Nasdaq and we're like, hey, the Nasdaq's flying, let's look at the Qs here. Nasdaq's flying, everything's great. But then you look on the street and you see, shops closing, you see businesses closing. There's a big disparity going on. So we've got to be very careful we don't look at what's happening on the street and go, that's what's happening in the market as well. And we've got to be careful that we understand the constituents in the market. Nasdaq, of course, very tech heavy. The FANGs are doing exceptionally well. Of course, why wouldn't they be? It's all technology based. All the cloud companies, all the software companies, all these companies are generally doing well because they don't have a less of an impact. If anything, coronavirus assists their business model. A lot of people start to move stuff online. So we've got to be mindful of that. However, if we go back to the initial question, are we going to have another stock market crash? Let's look at something like the SPY, S&P 500 ETF. For all intents and purposes, guys, I'm looking at the S&P 500 here. Technicals would say, hey, if we went off to a larger chart time frame, monthly, we are at super highs. Yes, we had a little bit of a blip during coronavirus, but not as nearly as bad and as prolonged. And maybe for an order of magnitude, yes, and understandable, because it was pretty heavy on those days. I remember it vividly when we saw those brutal moves on some of the stocks, but not prolonged like we saw with the tech bubble bursting and we saw the global financial crisis. So where could we go and be defined as a crash? Well, if we start testing those coronavirus lows again, that's pretty bad, and that would probably indicate a crash, whatever you want to define it. Now, the interesting thing is, of course, if the S&P 500 does start to test the lows there, think what the FTSE 100 is going to do. FTSE 100 is going to be way lower than the coronavirus lows. That's going to be impacted way more heavily. Now, the thing is, will the Nasdaq crash as well? Who knows, guys? That's more of a valuation issue, I feel, than some of the economic challenges that some of the companies will come under in the S&P 500. I know there's some synergy there, I accept that, but we've got to understand there's a big split here. So, but then again, in the day, if people are running for the hills, it doesn't matter about valuations. All it does is add fuel to the fire. Reverse valuation is extended. If you imagine, again, no idea about valuations, not something I'm interested in, but if you imagine that the valuation or expected valuation for the S&P 500 is sitting here at 300, for argument's sake, someone can correct me if I'm wrong, I'm sure there's data out there. The idea is that if we came back to an expected average valuation, it wouldn't be anything like that. It would look more like a moving average, by the way, but imagine that's where it was. What happened is we overextend. So even though we take off the cream, that's the initial drive lower, and then we're likely to overextend, just like we did in the global financial crisis, just like we did on the dot-com bubble burst. So being prepared for that. Going back to the technical aspect, let's look at the SPY again on a daily chart. We could unwind and it could look quite brutal. We could come down and do half the move, come down to that 270, it could look quite brutal. There's a few things to think about. From a technical perspective, is it possible? Yes. We've taken out the highs. I don't think we do it before the election. Personally, I think we range bound and we chop in a range until the election. Could be wrong, but the way I'm playing it personally, some shorts, some longs, looking for individual setups in the stocks. There are some super strong stocks out there. VSLRs are a kind of great example. I don't want to point stocks in this or recommend stocks specifically, never make any recommendations, guys. Anyway, it's all dependent on your setup and your strategy, but give an example of strong stocks. Zoom, VSLR, these things are pushing to highs regardless. Then look at things like Citigroup, look at things like Rolls-Royce in the UK, all pushing to relative lows. So it's relative depending on what the company is. So we've got to be mindful again about the constituents in the company. Okay, so what could cause a catalyst to the downside? Obviously, investors and people in looking at the stock market have in their memory that this move was caused by coronavirus. Now, we didn't know at the time how bad it was going to be. We didn't know at the time what was really going on in China, and unknowns are generally what spooks the market. Now we know a bit more. I personally, again, don't feel that unless something crazy happens, that coronavirus is going to be much of a catalyst. Personal preference, let me know your thoughts on that in the comment section below, guys. I think even if we do get a resurgence of it, I think even if we do kind of have to have some damage, a small amount of damage to the economy, and there's a slower growth back, I feel that the unknown of it was more the impact. So I don't think we'll get the same down move. Now, could that start a grind lower, in more of a range bound that grinds lower? It could do. People could be looking towards, how do we get out of this problem? Is it going to be like this forever? Is it going to put a dampener on growth? They'll be looking further forward. This was unknown. This was like, we don't know what's going on. These companies are shutting. We're locking down the economy. Will they ever reopen again? Will you ever be able to go to the cinema again? Now we're starting to see that it's perhaps not as devastating as some of the worst predictions. Some of the worst predictions were pretty bad, let's be honest, and we didn't know at that time. So I don't feel that's going to be a catalyst. Another catalyst that we could have, okay, guys, who knows if I'm right or wrong? I'm really interested to hear your thoughts on this one. Another catalyst we could have is some sort of deadlock with the US election. I don't pretend to be an expert in US elections, but if we have something surprise there or some sort of deadlock, that could cause, again, uncertainty. That's the one thing to look for. Markets don't like uncertainty. We could have a trigger, a catalyst like the GFC. We could have the auto loans and the student loans and just a debt crisis again. Will it be the same order of magnitude? Probably not. But again, it's probably going to come from somewhere else. But it pays to sort of look where the risks are. Maybe it's something like you just take stocks going out of favor. Perhaps the growth isn't there. Perhaps people are just considering them as a valuation mean reversion. I don't think that's as likely. I think because there's so much money coming into the market, because money is so cheap. Now, of course, that would be an additional catalyst if interest rates were to rise. That would shock a lot of things. But the way it's looking is like they're going lower. Looks like it might be a negative rate environment. But that's by the by. Could we have a kind of reversion to the mean based kind of drive lower? Oops, it's got on cues. Let's see. I mean, Nasdaq, obviously, to me, if we went back to coronavirus lows, that would be pretty horrible for it, wouldn't it? Even coming back to coronavirus highs would be fair. A pre-coronavirus would be fair. 200 might look a bit crashy, especially when 300. That's a not very nice chart to look at if you're long on tech stocks. But a mean reversion, if we put this onto a monthly chart, guys, mean reversion doesn't bring us back too far. It's not, wouldn't be the end of the world for it. But again, we've got to be prepared for it. So how am I positioning for it? So some of the catalysts, and again, another one, perhaps final one. I'm always interested to hear what you guys got to say about this. Maybe, again, I'm thinking kind of multiple moves ahead here. We've seen a lot of people, specifically Trump, blaming China for the virus. Now, does that get ramped up and become more of a conflict? The trade war was a big thing going into that. That's what everyone was concerned about. They were trying to do a deal on that. Let's assume that the election is done. Let's assume Donald Trump gets in again. Now, will he now up his finger pointing at China, causing a bit of a bigger trade war, causing a conflict? I'm not saying a military conflict, but some more conflict, which does affect some of the global economic growth. That's a potential. Or maybe if Biden gets in, maybe Biden starts doing that. Who knows? I think there's a lot to play for, guys. There's a lot going on. From a technical perspective, I feel that we're sitting in a range-bound environment here. Finally, I just want to say to you, I think that the way to approach it at the moment is to look at, if you're trading equities, by the way, is to swing trading equities, is you've got some shorts, and we've seen some charts there that are very, very weak, picking your shorts on those, and some longs, whilst you're in a range-bound environment, just playing both sides of the coin, grabbing some profits as the market rotates back and forth. And then if we start to get aggressively a bid again, then you can kind of focus on some of those longs, pushing those longer. That's the way that I'm focusing on it. Seems to be working okay at the moment, but whilst we're in the range-bound environment, I'm not going to be just looking at longs. Definitely not going to be looking at shorts. Slightly more biased to longs, but having a few shorts sprinkled on there that are actually good setups individually, thinking, well, if we rotate back to lows here, they're going to make me money. I might get stopped out on the longs, but the risk order ratio on the deals are always going to overcome any stop loss you take. That's my thoughts, guys. Are we due for a second crash? Nobody really knows. That's the point. Everyone, we can all speculate. We can be prepared for it. And the thing that I will be doing is I'll be looking to see what other traders are looking at. Traders who've got influence on the market. Where are those eyeballs? Where's the financial media looking? I don't like to look at financial media too much, but are they looking at China? Are they looking at coronavirus? Are they looking at the election? Are they looking at credit? Where are those eyeballs? Because that will give you a hint as to potentially what some of the bigger players are looking at. And the bigger players are the kind of players that are moving money in or out the market or rotating it into other things. All right, guys, take care. Keep your risk managed. Let me know your thoughts in the comment section below. See you next one. Bye-bye.